Tesla is the number one reason why your investment portfolio is underperforming in December of 2022. In this video, I want to kind of go over this very interesting correlation that I've witnessed over the past few weeks as Tesla stock has come down significantly over the past month, down over 50%, and all the turmoil that's going on around social media with this company and the Twitter deal, and how that is actually affecting your own stocks regardless of what kind of sector you're investing in. You guys already know that on this channel, I primarily focus on very high growth and unprofitable companies. And although most fund managers would disagree with the investing style that I follow for very obvious reasons, I have started to see a very interesting correlation with the performance of Tesla stock and what's been going on in my own portfolio. And that is exactly what I want to address in this video, because it's going to help a lot of you investors to understand what moves the stock market in the short term and how you can leverage that to your own benefit to make money in the long term. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's understand where Tesla stock is going, why it's gone down, and how is it faring against some of the other large cap companies. Now, you guys already know Tesla stock was one of the darlings of 2020 and 2021. We saw an insane turn to profitability for the business, a lot of positive free cash flow, and obviously a lot of hype around Elon Musk, which caused the stock to go up more than 1,600% in a matter of 12 to 18 months. But now what's happened is that as the interest rates have gone up, the 10-year yield has skyrocketed, and inflation is starting to come down. It looks like people are going to spend less money purchasing products from a company like Tesla, which obviously sells very luxury and high-end vehicles for the most part. Even the cheapest Tesla Model 3 costs more than $40,000 brand new, which obviously is still out of the realm for most people. And in an environment like this, where people are cutting spending like crazy, it's easy to see why Tesla could underperform from a business standpoint in 2023. And that is the case for a lot of tech and growth companies. A lot of demand was pulled forward in 2021 for these companies, and now they're struggling and potentially going to see negative growth over the next 12 months. And that is exactly what the stock market is trying to price in. But obviously, this does not mean that as a long-term investor, these companies are poor investments. They can be good businesses if you're buying the right fundamentals and you know how to deal with patience and the volatility of the market. But the really interesting thing with what's been going on with Tesla is that Tesla was actually a stock that performed relatively well back in 2022 at the very beginning. Despite the mayhem we saw in growth stocks, particularly with the ARK-K fund, which is obviously Cathie Wood's flagship fund, Tesla stock held up relatively well. And this was actually also followed by something like Apple, which also performed very well in the first half. And so if you are looking for this market to bottom anytime soon, the reality is that all the companies in the index, particularly for the S&P 500, should bottom and should see some form of capitulation. But we had not seen that with Tesla or Apple just yet. And you see, that is probably the biggest reason why your own portfolio is still underperforming, because the market still has more fear that it has to price in with the declines of Apple and Tesla. Amazon, Nvidia, Google, and even Microsoft and Meta have been destroyed in the form of valuations in 2022 already, but Apple and Tesla were the ones that had to catch up to those declines, because obviously those companies are still extremely consumer focused, and the consumer is the one that's getting squeezed in this Federal Reserve interest rate hike cycle. And as we all know, Tesla was at one point one of the top 10 holdings of the S&P 500. And when you have a growth company that is in a very cyclical industry like the auto business, you should expect that stock and valuation to also come down before you can expect the entire market to bottom. Because as we all know, growth stocks tend to be the first ones that go up at the start of a bull market, and they tend to be the last ones that go down at the start of the next bear market. And that is exactly what we need for this market to actually bottom and some relaxation to take place for 2023. And as you can see, I've already been affected significantly by this. Even though the S&P 500 kind of bottomed around that October timeframe, my portfolio has actually not done that well since then. As a matter of fact, my portfolio just hit a 52-week low, even though the S&P 500 is actually up a little bit since that time frame. And this, in my opinion, is all due to something like Tesla stock, because Tesla's been going down, and that has caused the entire market to fear most growth companies that are unprofitable. Tesla's profitable, but it does end up moving EV stocks, clean energy companies, and as a result, your portfolio is probably being significantly affected with the drama we're seeing around Tesla and Elon Musk. And let's be honest, with the way that the ARK Innovation ETF collapsed around 80% over the past year, Tesla at some point had to follow. And as you can see, in the summer and spring of 2022, there was a very big gap between what Tesla was doing and what ARK-K was doing. But now Tesla has finally caught up to the declines of ARK-K, because obviously it is one of the biggest holdings of that fund, and it's safe to say that ARK-K has become that barometer of risk appetite in the stock market. And for the next bull market to really start, you're going to need ARK-K to bottom first before anything can happen. And so yes, even in the short term, it's obviously extremely painful to see inflation having peaked and the money supply having collapsed, but your stocks still not performing that well. In the long term, this is a right sign in the right direction. The market is always designed to fool the majority and shake out weak investors, and I think that is something we're seeing right now in the growth, electric vehicle, and clean energy sectors, where valuations have come down significantly over the past few months on pretty much no bad news for the regular sector. Pretty much investors are just trying to price in a poor earnings growth for 2023, and although some companies will struggle, others will fare better, and at some point markets will realize the valuations for these companies might be overpriced at the downside, as obviously money supply has gone down. It's also important to realize that this is probably one of the most difficult markets to be an investor in over the past couple of decades. Even back in 2008, we hadn't seen this form of growth stock destruction that we're seeing right now in 2022, especially one that is extended for such a long period of time. But overall, as a longer-term investor, this is probably more of an opportunity than a time to sell, and that is exactly what I'm doing, even though, yes, I've made many mistakes over the past year in my investing career. Just to give you an example, Corsair Gaming was one of the stocks I had invested in back in 2021, but after I realized that the consumer electronics industry simply had too much demand pulled forward, and that the business for consumers is just going to struggle in 2023 as interest rates go up, this is a stock I decided to take my investment loss on. And although it is true that once interest rates are cut in 2024, that growth stock valuations will probably start to ease and start going up again, I simply saw a better opportunity for putting my money in companies that I probably had higher conviction in. And although being down 60% for the year is not nice, I do realize that 2022 is more of an anomaly year after obviously a very big anomaly in 2020 and 2021. And although for many people my own portfolio would be considered extremely high risk, I am making sure that I'm diversifying in the right industries that I have actual knowledge about from a practical standpoint, and making sure that I have diversification in index funds and ETFs that'll help mitigate some of my risk to the downside going into 2023. This is certainly a very interesting time to be an investor, so let me know your thoughts down in the comment section below, and I'll catch you guys in the next one. Take care.